Ladies and gentlemen, what I'm about to share with you isn't just another market story. This is about a metal that's been sitting in the shadows for decades, quietly powering the world you live in. And right now, in the closing days of 2025, something extraordinary is happening. Something that could reshape your purchasing power, your savings, your future. While most Americans are drowning in credit card debt, watching their grocery bills climb every single month, feeling that gnawing anxiety about retirement accounts that never seem to grow fast enough, a silent transformation is taking place in a corner of the financial markets that almost nobody is paying attention to. Silver. Yes, silver. The metal your grandmother kept in a drawer. The metal that's been dismissed, ignored, ridiculed even, for years. But right now, institutional giants are making moves that they haven't made in generations. And when these players shift their positions, when they flip their entire strategy, after decades of consistency, you need to understand why. Because what's coming in 2026 could be one of the most dramatic repricing events in commodity history. And it's not being driven by speculation or hype. It's being driven by something far more fundamental, far more inevitable: physics, geology, geopolitics, and the cold mathematics of supply and demand. Let me take you back to where most Americans are right now emotionally. You've watched the Federal Reserve promise that inflation was transitory. You watched it become permanent. You've seen housing prices double in cities where your children will never afford to buy. You've watched your paycheck stretch thinner every year while being told the economy is strong. There's exhaustion that's set in, a fatigue from being told one thing while experiencing another. Trust in traditional markets is fraying. People are looking for something real, something tangible, something that can't be printed into existence by a central bank or diluted by a boardroom decision. Gold has always played that role historically. But gold is expensive now, hovering around $4,500 an ounce, out of reach for many families just trying to protect what little wealth they've managed to accumulate. Silver, on the other hand, has been trading in the shadow of gold for so long that most people forgot it has a dual identity. It's not just a monetary metal, a store of value that's been recognized for 5,000 years. It's also the most industrially indispensable metal on the planet right now. And that combination, that intersection of monetary demand and industrial necessity, is what makes what's happening right now so unprecedented. Let me explain something about silver that your financial advisor probably never told you. Silver is in everything. It's in the solar panels that are being installed across rooftops in Texas and California as America races toward energy independence. It's in the electric vehicles that are rolling off production lines in unprecedented numbers as the world transitions away from combustion engines. It's in every smartphone, every computer, every server farm powering artificial intelligence. It's in medical devices and water purification systems, in 5G infrastructure. Silver conducts electricity better than any other metal. It conducts heat better than any other metal. It's the most reflective metal on Earth. And it's antimicrobial, meaning it kills bacteria on contact. These aren't properties that can be replaced easily. Engineers have tried for decades to find substitutes, and for the most critical applications, there simply aren't any. When you hear about the AI revolution, about data centers consuming massive amounts of energy, about the chip manufacturing that's being reshored to America under the CHIPS Act, you're hearing about silver demand that didn't exist 5 years ago and is now structural, permanent, and growing exponentially. But here's where the story gets interesting. And this is where you need to pay very close attention, because this is where the pieces start connecting in a way that should make anyone holding dollars, anyone worried about their savings, sit up and take notice. For decades, the silver market has been defined by something unusual, a consistent, large, concentrated short position held by a small number of banks. These weren't small positions. We're talking about hundreds of millions of ounces, paper contracts representing silver that didn't physically exist, sold into the market to provide liquidity, but also, many analysts have argued, to suppress price discovery. Now, I'm not here to litigate the conspiracy theories. What I'm here to tell you are the facts, and the facts are documented in regulatory filings and market data. One institution in particular has been at the center of this positioning for years, JP Chase, the largest bank in America. And something has changed, something big. Throughout 2025, data began emerging that suggested JP Morgan had done something almost unthinkable. After years, decades even, of holding massive short positions in silver futures, the bank appears to have not just reduced those positions, but completely flipped. Reports from commodities analysts, some with access to proprietary positioning data, began circulating that JP Morgan had closed out approximately 200 million ounces of paper short positions between June and October of 2025. That alone would be extraordinary. But what came next was even more remarkable. The same analyses suggested that JP Morgan now holds a long position in physical silver, not paper contracts, actual metal, of approximately 750 million ounces. Let me put that in perspective for you. 750 million ounces of silver at current prices, which recently touched $65 per ounce, represents more than $40 billion in value. That's not a trade. That's a strategic position. That's a position you take when you believe something fundamental has changed in a market, and you want to be on the right side of what's coming. Now, why would a bank do this? Why would JP Morgan, an institution known for sophisticated risk management, for playing both sides of commodity markets, suddenly take such a one-directional bet? To understand this, you have to understand what banks see that retail investors usually don't. They see order flow. They see industrial procurement contracts. They see refining capacity constraints. They see the pipeline of demand that's coming down in the next 12 to 24 months before it hits the public consciousness. And what they've been seeing in the silver market is something that doesn't happen often in commodities, a structural deficit that can't be easily fixed. Let me walk you through what a structural deficit actually means, because this is crucial. Every year, the world mines approximately 800 million ounces of new silver from the ground. That's it. That's the fresh supply. Additionally, somewhere around 200 million ounces gets recycled from old electronics, old jewelry, old industrial applications. So total supply, new and recycled, is roughly 1 billion ounces per year. Now let's talk about demand. Industrial demand alone, just the factories that need silver to make products, is consuming around 600 million ounces per year. Investment demand, people buying coins, bars, exchange-traded funds, adds another 250 million ounces. Jewelry and silverware take another 200 million ounces. You do the math. We're talking about annual demand exceeding 1 billion ounces, and that's before we account for the explosive growth in solar panel manufacturing, which is expected to increase silver demand by another 100 million ounces annually over the next 3 years as countries race to meet climate commitments. The deficit isn't theoretical, it's mathematical. And deficits in commodity markets, when they persist, when they can't be resolved by bringing new supply online quickly, lead to one thing: price adjustments, sharp ones. But supply isn't just about mining, it's about refining. And this is where the story takes a geopolitical turn that most people haven't connected yet. China doesn't mine the most silver in the world, Mexico and Peru do, but China controls approximately 40% of global silver refining capacity. Chinese refineries take raw silver, purify it to the standards needed for industrial applications, and ship it worldwide. It's been an efficient system, a globalized supply chain that worked seamlessly for decades. But in late 2025, signals began emerging from Beijing that changed the calculus. China announced that beginning in early 2026, it would implement export restrictions on certain refined metals, including silver, citing national security concerns and the need to prioritize domestic industrial needs, particularly in renewable energy and advanced technology manufacturing. The restrictions aren't a complete ban, but they introduce quotas, licensing requirements, and significant friction into a supply chain that global industry depends on. And the timing couldn't be more significant. Think about what this means practically. If Chinese refineries can only export a portion of what they've historically supplied to global markets, where does that silver come from? There are refineries in other countries, yes, but they're already running at capacity. You can't just build new refining infrastructure overnight. It takes years, requires specialized equipment, environmental permits, skilled labor. Meanwhile, solar manufacturers in Europe and the United States, electric vehicle producers, electronics companies, they all have production schedules, contracts, committed deliveries. They need silver, and they need it in refined form, meeting purity specifications. When supply gets constrained and demand remains constant or increases, buyers don't just accept shortages, they compete, they bid up prices, they secure future supply at premiums. This is basic economics. But when it happens in a market as relatively small as silver, a market where the total above-ground investment grade silver in the world is estimated at around 2 to 3 billion ounces, far less than gold in proportional terms, the price moves can be violent and sustained. Now, let's connect this to what JP Morgan might be seeing. If you're a major financial institution with access to the best commodities analysts in the world, and you see industrial demand accelerating, mining supply stagnant, refining capacity getting choked by geopolitical restrictions, and a deficit that's projected to widen, what do? You stop betting against the market, and you start accumulating the physical metal. And if you're going to accumulate, you do it before the wider market realizes what's happening, before the price runs away, before every hedge fund and sovereign wealth fund starts competing for the same limited supply. That's what appears to have happened in 2025. The smart money, the institutional money, quietly repositioned while retail investors were still debating whether inflation was real and whether the stock market could keep hitting new highs despite deteriorating fundamentals. But let's not get ahead of ourselves. Let's talk about what actually drives price in commodity markets, because this isn't just about supply and demand in a vacuum. It's about psychology. It's about momentum. It's about feedback loops. Silver has a history of doing nothing for years, boring traders to tears, and then exploding into short, violent moves that catch everyone off guard. In 1979 and 1980, silver went from $5 an ounce to $50 an ounce in a matter of months, driven by a combination of inflation fears, geopolitical instability, and the Hunt brothers attempting to corner the market. In 2011, silver rallied from $18 to nearly $50 again in less than a year as investors fled quantitative easing and sought hard assets. Both times, the rallies ended badly with sharp crashes, and those crashes scared away a generation of investors who learned to view silver as too volatile, too manipulated, too unpredictable. But what if the setup now is different? What if this time the move isn't driven by speculators or inflation panic alone, but by actual physical shortage, by industries that can't function without the metal bidding against investors who finally wake up to the deficit? Here's where volatility compression becomes important. For most of the past decade, silver traded in a relatively narrow range, between $15 and $30 an ounce. Volatility was low, interest was low, the market was quiet, boring even. But when volatility compresses for a long period in any market, energy builds up. It's like a coiled spring. And when that spring releases, when volatility expands, prices can move much faster and much further than anyone expects. We saw the beginning of that expansion in late 2024 and accelerating through 2025. Silver broke through $40, then $50, then $60, hitting all-time nominal highs above $65 per ounce. The speed of the move caught many analysts off guard. But if you understand the mechanics, if you understand that years of suppressed volatility combined with tightening physical supply create conditions for explosive price discovery, then what happened makes perfect sense. And the question becomes, is this just the beginning? Let me give you a framework for thinking about where silver could go from here. Not as a prediction, but as a scenario analysis. Because nobody can predict markets with certainty, but we can assess probabilities based on historical precedent and current fundamentals. In a conservative scenario, one where industrial demand continues growing modestly, where China's export restrictions create friction but not crisis, where investment demand ticks up but doesn't flood in, silver could trade in a range of $60 to $80 through 2026. That's roughly a 20 to 30% gain from current levels, meaningful but not spectacular. In a bullish scenario, one where a combination of supply shortages, continued industrial demand growth, and moderate investment inflows occur, silver could push toward $100 to $120 per ounce. This would represent silver regaining its historical price ratio relative to gold, which has been distorted for years. Historically, the gold to silver ratio averaged somewhere between 15 to 1 and 30 to 1, meaning 15 to 30 ounces of silver equaled 1 ounce of gold. Right now, even with silver's recent gains, that ratio is still around 35 to 1. If it reverts to the historical mean and gold stays where it is, silver would need to be closer to $70 to $80 just on ratio reversion alone. If gold rises, which many expect given monetary instability, silver could go much higher. Then there's the extreme scenario, and I want to be very clear that this is low probability but not zero probability. In an extreme scenario, one where China's export restrictions prove more severe than expected, where a supply crisis develops in key industrial sectors, where investment demand surges as confidence in fiat currencies erodes further, and where short covering by remaining institutional shorts accelerates, silver could spike well beyond $150 per ounce. This isn't baseless speculation. In inflation-adjusted terms, the 1980 high of $50 would be around $150 today. The market has been there before in real terms. Could it get there again? The question isn't whether it's possible. The question is what combination of factors would need to align. And increasingly, many of those factors are already in motion. Now let's bring this home to what it means for you, for regular Americans, trying to navigate an increasingly unstable economic environment. If silver prices rise substantially, and I mean sustainably, not just a speculative spike, the effects ripple through the economy in ways most people don't consider. First, anything that uses silver becomes more expensive. Solar panels get more costly, potentially slowing the energy transition or requiring more subsidies. Electric vehicles could see marginal price increases as manufacturers face higher input costs. Consumer electronics, smartphones, laptops could inch up in price. Medical devices that rely on silver's antimicrobial properties could cost more. These aren't catastrophic increases. Silver represents a small fraction of the final product's cost in most applications, but they're real. For industries, it means tighter margins or cost passed through to consumers. For consumers already squeezed by inflation, it's one more pressure point. But there's another side to this. For Americans who own silver, whether in coins, bars, or mining stocks, a substantial price rise represents wealth preservation or even wealth creation. in an environment where most assets feel overvalued or risky. It's a way to participate in the commodity supercycle that many analysts believe is just beginning, driven by the energy transition, infrastructure spending, and deglobalization. It's a hedge against further currency debasement if central banks continue to struggle with inflation and debt dynamics. And it's a tangible asset, something you can hold, that doesn't depend on a company's earnings report or a government's promise. In a world where trust is eroding, where people feel disconnected from the levers of economic power, physical assets represent a form of autonomy, of independence. The psychological element here matters enormously. Markets are not just mathematics, they're human behavior at scale. Fear and greed, the two most powerful forces in markets, drive decisions far more than spreadsheets do. Right now, very few retail investors own silver. It's not part of the standard portfolio allocation. Financial advisors rarely recommend it. It's seen as fringe, as something for preppers or gold bugs. But what happens when the mainstream financial media starts covering silver shortages? What happens when CNBC runs segments on the JP Morgan position? What happens when industrial companies publicly state they're facing procurement challenges? Fear of missing out, FOMO, is one of the most potent drivers of late-stage bull markets. When people who ignored an asset for years suddenly see it doubling, tripling, they don't calmly assess fundamentals. They panic buy, they chase. And that chasing, that momentum, can drive prices far beyond what fundamental analysis would suggest is rational. We've seen it in cryptocurrencies and meme stocks and housing bubbles. Silver is not immune to this dynamic. In fact, given its small market size relative to other asset classes, it's particularly susceptible to it. Conversely, fear works the other way. If the market turns, if a recession hits and industrial demand craters, if investment flows reverse, silver can fall just as violently as it rises. The volatility cuts both ways. This isn't a risk-free trade. This isn't a guaranteed path to wealth. What it is a market in transition, a market where the fundamentals have shifted in ways that create asymmetric opportunity for those who understand the dynamics and accept the risks. The key is understanding what you're buying and why. Are you buying because you believe in the structural deficit? Are you buying as insurance against monetary instability? Are you buying because you think momentum will drive prices higher and you want to ride that wave? The answer determines your time horizon, your position size, your exit strategy. Let's zoom out and think about the bigger picture for a moment, because silver doesn't exist in isolation. It's part of a broader story about the end of easy globalization, about supply chain fragmentation, about resource nationalism. China's export restrictions on silver are not happening in a vacuum. They're part of a pattern. In recent years, China has restricted exports of rare earth elements, of gallium, of germanium, all critical to technology and defense industries. The message is clear. Beijing is using its control over key resources as geopolitical leverage, and the West is waking up to the vulnerability. The United States and Europe are scrambling to secure alternative supply chains, to reshore mining and refining capacity, to reduce dependence on Chinese processing. But this takes time, and in the interim, there's a window where China holds enormous power over critical materials. Silver is just one piece of this puzzle, but it's an important piece, particularly given its role in the energy transition that Western governments have staked their climate policies on. This geopolitical dimension adds another layer of risk and opportunity to the silver market. If tensions between the US and China escalate further, if trade restrictions multiply, if we move toward a more fragmented global economy with competing blocs, commodities become weapons. They become strategic assets, not just economic goods. Governments start building stockpiles, industries start hoarding, prices become less about marginal supply and demand and more about security of supply at any cost. We saw hints of this during the pandemic when supply chains broke down and suddenly everyone realized how fragile global logistics were. Silver could be the next stress point, and stress points in commodity markets create price spikes. Let me paint one more picture for you, a picture of what America might look like if silver goes to $100 or beyond and stays there. The solar industry faces a reckoning. Companies that locked in silver prices at lower levels make fortunes. Companies that didn't face bankruptcy or consolidation. The U.S. government, which has committed hundreds of billions to renewable energy under the Inflation Reduction Act, either has to increase subsidies or accept that the energy transition will be slower and more expensive than planned. Mining companies, particularly those with silver exposure, see their stock prices soar. Workers in mining regions see new jobs, new investment, boomtown dynamics. But refiners become the bottleneck. Whoever controls refining capacity controls the market. Suddenly, there's a race to build new refineries in North America, to reduce dependence on China, but it takes years and billions of dollars. In the meantime, manufacturers scramble, they substitute where they can, they redesign products, they pay up for scarce supply. Investors who saw this coming early, who bought silver coins, bars, or mining stocks, watched their positions multiply in value. They feel vindicated after years of being mocked for holding a boring metal that didn't perform. They feel smart, prescient even. And they face a new question: when to sell, how much to sell, whether to hold for even higher prices or lock in gains. This is the psychology of bull markets. The fear of selling too early becomes as powerful as the fear of buying too late. People check prices obsessively. They read every piece of analysis. They join online communities of fellow silver investors, reinforcing each other's conviction, creating echo chambers. The media starts running special reports. Politicians start talking about strategic reserves and domestic production. And through all of it, the fundamentals, the actual supply and demand, grind forward, indifferent to the narrative, indifferent to the emotion. Eventually, every bull market ends. The question is how? Does silver top out at $90 and slowly deflate as new supply comes online and demand moderates? Does it spike to $150 in a panic and then crash back to $70 as industrial users pull back and investors take profits? Does it plateau at a new higher equilibrium, say $80 to $100, and trade there for years as the market accepts a new normal? Nobody knows. But understanding the range of possibilities, understanding the forces at play, gives you a framework to make decisions that align with your goals and risk tolerance. This isn't about getting rich quick. This is about understanding a once-in-a-generation shift in a critical commodity market and positioning accordingly. I want to close with a thought that ties everything together. Markets, ultimately, are expressions of collective human behavior under conditions of uncertainty. They reflect our hopes, our fears, our assessments of the future, and our mistakes in judgment. Silver has been underestimated for so long precisely because it's neither fully money nor fully commodity. It exists in a strange middle ground, too cheap to be taken seriously as a monetary asset like gold, too scattered across industrial applications to be viewed as a pure commodity play. But that duality, that hybrid nature, is exactly what makes it so interesting right now. As monetary confidence erodes and industrial demand explodes, silver sits at the intersection of two powerful trends. And when JP Morgan, an institution that has been on the other side of the silver market for decades, flips its position and accumulates physical metal on a scale that represents 1 year of global mining output, that should tell you something. It should tell you that someone with vast resources and deep market insight believes the equation has fundamentally changed. China's export restrictions are not just a policy footnote. They're a signal that the era of frictionless global commodity flows is over. Resources are being weaponized, supply chains are fracturing, and nations are prioritizing domestic needs over global efficiency. In that world, the countries and companies that secure critical materials early, that build resilient supply chains, that invest in domestic capacity, those are the winners. Everyone else scrambles and pays up. Silver is a microcosm of that broader shift. It's a test case for how commodity markets will function in a more fragmented, less cooperative global order. And for individual investors, for American families trying to protect purchasing power in an inflationary environment, understanding these dynamics isn't optional anymore. It's essential. So where does that leave us? It leaves us at a moment of clarity and consequence. The setup is visible. The catalysts are in motion. The institutional money has already moved. The question is whether the rest of the market, whether investors, whether you, recognize what's happening before the opportunity passes. Silver may not make you wealthy overnight. It may not be the answer to every economic anxiety. But it represents something tangible in an increasingly abstract financial world. It represents exposure to trends that are reshaping the global economy, the energy transition, technological advancement, geopolitical competition. And it represents a bet, a calculated bet, that supply and demand still matter, that markets eventually reflect fundamentals, even when they seem manipulated or irrational for long periods. You don't have to buy silver. You don't have to believe any of this. Markets offer infinite choices, infinite opinions, infinite strategies. But you do have to be aware. You do have to understand that something is shifting. Whether you act on it or not, whether you profit from it or not, the changes are coming. JP Morgan's flip from short to long signals institutional awareness. China's export restrictions signal geopolitical shift. Silver's breakout to all-time highs signals market recognition. The pieces are on the board. The game is in motion. And in 2026, we'll see whether this was the beginning of a historic commodity bull market or just another false start in silver's long, volatile history. Either way, the story is unfolding now, and understanding it, really understanding it, puts you ahead of the vast majority who remain distracted, unaware, unprepared. That understanding, that awareness, is the real edge in markets. And right now, in silver, that edge is available to anyone willing to look past the noise and see the structural forces reshaping this forgotten metal's future. If this analysis has opened your eyes to the silver opportunity unfolding right now, don't let this moment pass. Subscribe to stay ahead of the curve as this historic market shift continues to develop through 2026.